For any business that sells a physical product, anything from a tiny coffee shop to a massive car manufacturer, there's this constant, high-stakes balancing act going on right behind the scenes. It's all about inventory. And getting it right, well, that's one of the trickiest and most important jobs in the entire business world.
It creates what people often call the Goldilocks problem. You know the story, right? If you have way too much inventory, you're just burning cash. That money is literally sitting in boxes on a shelf. You're paying to store it, to insure it, and all the while you're risking those products going out of style. But if you have too little, your shelves are empty, and that means you're losing sales, frustrating your customers, and basically just handing business over to your competition. Either way, you lose.
So, the big question is, how do you even measure this? How do businesses know if they're in that perfect, just right zone, or if they're leaning way too far in one direction?
Well, that's where a really important metric comes in. Think of it as the official scorecard for this whole balancing act. It's called the inventory turnover ratio.
In simple terms, this ratio tells you exactly how many times a company managed to sell and then restock its entire inventory over a certain period, usually a year. It's a direct measure of speed and efficiency. Are your products flying off the shelves, or are they just sitting there collecting dust? This number tells you.
Okay, so how do we actually get this score? The formula itself is pretty simple. You take the cost of goods sold, or COGS, and you divide it by your average inventory. Now, the real magic here isn't the math. It's why we use these specific numbers. We use COGS because it's the actual cost of the items. It gives us a true apples-to-apples comparison. And we use the average inventory to smooth out any wild seasonal swings, which gives us a much more honest picture of the whole year.
Let's make this super clear with an example. Say a company's cost of goods sold for the year was $1 million, and their average inventory was worth $250,000. Okay, you divide 1 million by 250,000 and you get 4. What does that 4 mean? It means that company sold and completely replenished its entire stock 4 times over the course of the year.
All right, so you've got a number, 4. So what? What does that number actually tell us about the health of the business? Let's dig into the story behind the score.
Generally speaking, a high turnover score is exactly what you want to see. It's a huge thumbs up. It means sales are strong, your operations are humming along, and you're turning products into cash really quickly. But a low score? That's a red flag. It's screaming that sales might be weak and you've got way too much inventory just sitting there, tying up precious capital and risking becoming totally worthless.
So the takeaway is simple then, right? Just aim for the highest number possible. The bigger the better. Case closed? Well, it's actually a little more complicated than that.
See, believe it or not, you can have too much of a good thing here. A crazy high turnover ratio can be a danger sign. It might mean you're always running out of stock, which leads to lost sales and really unhappy customers. It could also mean you're placing tons of small orders, which drives up your shipping costs, and you're probably missing out on those nice bulk discounts from suppliers. Remember, the goal isn't just speed, it's profitable speed.
And this brings us to probably the single most important rule when looking at this ratio: context is everything. You absolutely cannot compare apples and automobiles.
Just think about it for a second. A grocery store selling milk and bananas needs to sell its inventory fast, right? So a good turnover for them might be 60 or even higher. A bookstore, maybe something around 8 is healthy. But a luxury car dealership, their ratio might only be 2. And for them, selling their entire lot of high-end cars twice in 1 year is a massive success. A good number is completely relative.
Okay, so knowing all this, if you're running a business and you see your score, what can you actually do about it? How do you work to improve it and find that perfect balance?
Well, the answer really lies in being smarter. Companies are using data to get way better at forecasting what customers are actually going to buy. They use strategic sales and promotions to get rid of slow-moving products, and many have adopted game-changing ideas like the just-in-time method. That means ordering goods only when they're needed. It doesn't just cut down storage costs, it frees up enormous amounts of cash that would otherwise be locked away in a warehouse.
And as you might expect, this whole process is getting a major high-tech upgrade. We're moving way beyond just looking at last year's sales. With AI and machine learning, companies are diving into predictive analytics. They can analyze market trends, social media buzz, you name it, to figure out what customers want, sometimes even before the customers themselves know it.
What all this really points to is a fundamental shift in how we think about inventory. The old goal was just to sell what you have sitting in your warehouse. But the new goal, the The true art of this balancing act is to predict demand so incredibly well that you only ever stock what you know is going to sell.